You can have a credit score that most people would kill for. We're talking 750, 780, even 800, and still get rejected for a mortgage or a loan. And when that happens, nobody explains why. You just get a letter. Sometimes it says something like insufficient income. Sometimes it says excessive obligations. Sometimes it's almost impossible to parse. But here's the thing. It wasn't your score. It was something else entirely. Something the bank was looking at the whole time that most people have never heard of. Today we're going to go through exactly what that is, what banks actually care about, why the credit score is only part of the picture and not even the most important part. No jargon, no politics, just the actual mechanism explained clearly so that next time you're looking at a credit decision, you know exactly what game is being played. Let's start with the myth. Most of us have been taught to think of our credit score as the thing, the number, the verdict. You do the right things, you pay on time, you don't max out your cards, you keep your accounts open, and you expect that to translate into getting approved when you need it. And honestly, that's a reasonable thing to believe because lenders talk about scores constantly. They advertise score requirements. They run ads about building your score. The whole system is framed around that number. So when someone with a 780 gets rejected, it feels like a glitch, like the system broke, like someone made a mistake. But there's no glitch. The score worked exactly as intended. The rejection wasn't about the score at all. It was about something else, something the score was never designed to measure in the first place. Here's the key thing to understand. A credit score measures your past behavior. Underwriting tests whether you can survive the next payment. That's the distinction that changes everything, and most people never hear it. So, what is a credit score? Actually, FICO, the company behind the most widely used credit scores, describes it like this. It's a way of rank ordering consumers by how likely they are to pay as agreed. That's it. It's a signal about your historical relationship with debt. It tells a lender, this person has, in the past, tended to repay what they borrow. High score, reliable track record. Low score, some issues in the past. That's the information the score carries, and that is genuinely useful. It's not irrelevant. It gets you in the room. But getting in the room is not the same as getting the loan, because once you're in the room, the real evaluation begins. When a bank or lender looks at your application for a mortgage, a loan, or even a credit card, they're not just reading your score, they're running what's called an underwriting process. Underwriting is the decision framework. It's how a lender asks, not just, is this person trustworthy, but can this person actually repay this specific loan under our rules, given everything we can see about their situation right now? These are different questions. The first question, are they trustworthy, is roughly what the score answers. The second question, can they actually repay this loan, requires a lot more information. Think of it this way. If you were lending a friend a significant sum of money, say £15,000, you might think about whether they've paid back money before. That's the score equivalent. But you'd also probably think about, do they have steady income? Will their job still exist in 2 years? Do they have a lot of other debts eating into their pay? If something goes wrong for them, a medical bill, a job loss, could they still make payments? And if worst came to worst, is there anything you could recover against? Banks think exactly like that. And that process, working through all of those questions, is underwriting. The Consumer Financial Protection Bureau in the US, which sets a lot of the baseline for modern lending standards, says that for mortgages, creditors must consider things like current income and employment status, the monthly payment on the loan itself, current debt obligations, the ratio of what you owe versus what you earn, and credit history. Not just the score, all of it, together. The score is one input. The underwriting file is the full picture. A credit score is a summary. Underwriting is the full investigation. So let's go through the factors that actually move the needle in that investigation. The first thing banks actually care about, far more than people realize, is capacity. Capacity is a technical word for, can you actually afford the repayments once everything else is accounted for? The measure lenders use is called DTI, debt to income ratio. It's simple. Take all your monthly debt obligations, credit cards, car finance, existing loans, any rent commitments they're aware of. Add up what you owe each month and divide it by your gross monthly income. Let's make that real. Say you earn £3,000 a month before tax. You have a car loan costing you £300 a month and a credit card minimum of £100. That's £400 going out. Your DTI before the new loan is about 13%. Fine. But now say the mortgage you're applying for comes with a £1,200 monthly payment. Your total obligations jump to £1,600 a month. That's over 50% of your gross income going straight to debt before you've paid for food, bills, or anything else. And here's what makes this interesting. Fannie Mae, which sets underwriting rules for a huge proportion of mortgages, says that for manually reviewed loans, the general maximum debt-to-income ratio is 36%. You can sometimes get up to 45% if other factors are strong. For automated decisions, up to 50%. That's it. Your credit score could be excellent. Doesn't change those thresholds. A bank isn't asking, are you a good person with credit? It's asking, after your bills, hit. How much room is actually left? This is why paying down existing debt before applying for a mortgage can be more effective than chasing 20 extra points on your credit score. The score is not the constraint. The DTI is. Now here's a section that surprises a lot of people. And honestly, once you hear it, it makes complete sense. Even if it doesn't feel fair at first, it's not enough to earn enough. Your income also needs to be stable, predictable, and, crucially, documentable. Fannie Mae's own guidance says that stable and predictable income is a foundational element in underwriting. Not just income. Stable income. Income with a documented history. Income that's reasonably expected to continue. Think about what that means for real people. If you're a salaried employee with the same employer for 3 years, you have a payslip every month and a P60 at year end. That income is easy to count. The bank can verify it. Tick. But if you're freelance, even if you earn more, you might have 6 months where your invoices spike and 3 months where they drop. You might have just started, which means there's no documented history. Or you might earn a lot in commissions, but commissions are variable by nature. Here's the thing. The CFPB's denial data backs this up explicitly. Temporary or irregular employment, unable to verify income, and length of employment are all listed as real, documented reasons why applications get rejected. This isn't discrimination against freelancers or the self-employed. It's the lender trying to answer a very specific question. Will this person still have this income in 2 years? And if they can't answer that with confidence, even if the income looks good right now, the risk profile changes. A lender often values boring income over high, but unstable income. There's also a subtler version of this that catches people off guard. If you recently got a pay rise, say you moved jobs and your salary jumped significantly, that might not fully count yet. Because the income doesn't just need to exist, it needs a track record. I earn enough, and the bank can count it are two very different things. Remember that. This one is especially relevant for mortgages, but it applies to a lot of secured lending. When a bank lends you money for a property, they're not just underwriting you, they're also underwriting the asset. The house, the flat, whatever it is, becomes part of the equation. Why? Because if everything goes wrong and you can't pay, the lender needs to be able to recover something. They need what's called an exit plan. And the quality of that exit plan depends on the collateral. The measure that matters here is LTV, loan to value. If a property is worth £250,000 and you're borrowing £200,000, your LTV is 80%. You have a 20% deposit in the deal. That 20% buffer means that even if the property falls in value somewhat, the lender can still recover what they lent you. If they ever had to sell it, their risk is protected. Federal Reserve Interagency Guidance classifies loans at or above 90% LTV as high LTV, meaning loans where the lender has very little collateral protection. Those applications face stricter scrutiny, and it doesn't matter how good your score is, banks don't just underwrite your promise to pay. On secured loans, they underwrite the exit plan. This is why the same borrower can be approved for one property, but not another. It's not necessarily you, it's the collateral value relative to the loan size that change the risk profile. This is probably the most overlooked factor. And for a lot of people watching this, it's the most actionable thing I'll say today. Reserves, cash in the bank, financial cushion. Fannie Mae explicitly includes liquid reserves as part of its risk assessment, alongside income, credit, and the property itself. It's a formal part of how mortgage applications are evaluated. Here's the logic, and once you hear it, it makes complete sense. Imagine two applicants. Both earn the same. Both have the same DTI. Both have the same credit score, but one has £8,000 in savings and one has £400. Who would you rather lend to? The one with savings, obviously. Because if that person loses their job for 2 months, has an unexpected medical bill, or has an overlap between paying rent and starting a new mortgage, they can absorb the shock. They don't instantly default. The person with £400 in savings has no buffer. One bad month and the bank's loan is at risk. To a lender, reserves are proof that one bad month won't instantly become their problem. So if you're preparing for a major credit application, building savings isn't just about having a deposit. It's a signal to the underwriter that you have financial shock absorption, that you're not at the edge. The last factor is one that people rarely talk about, but it causes a surprising number of rejections. Can the lender actually verify what you're telling them? This matters more than it sounds. You might be in a perfectly solid financial position, stable income, low debts, savings behind you. But if your income comes in ways that are hard to document, cash in hand work, irregular transfers, business income that doesn't clearly separate from personal, the lender may not be able to officially count it. And here's the thing. A lender who makes a mortgage loan typically needs to be able to show that they followed a defensible process. They need a paper trail. If they can't verify something, they often can't credit it, regardless of whether you and I both know it's real. The CFPB's denial form has a box that says unable to verify income. It's not income insufficient, it's unable to verify. The income might exist. It just couldn't be proven in the way the lender needed. A denial isn't always about being risky. Sometimes it's about being unverifiable. This is increasingly relevant as more people work in non-traditional employment. The income is real. The work is real. But the documentation doesn't match what the system was designed to accept. Okay. Quick recap before we move on. The factors banks actually underwrite: capacity, can you afford it? Stability, will your income hold? Collateral, what can they recover if things go wrong? Reserves, do you have any buffer? And documentation, can they actually count what you earn? Your score? It matters, but it's one input in a much bigger process. So now that we know how underwriting actually works, let's answer the two questions that confuse people most. First, why did I get rejected with a good score? You already know the answer now. Your score was fine. But something else in your file wasn't. Maybe your DTI was too high. Maybe your income was variable and couldn't be fully documented. Maybe you had a small deposit and the LTV pushed you into high-risk territory. Maybe you didn't have the reserves the lender was looking for. The score got you into the conversation. The underwriting found the problem. Second question, why did a different lender approve me? This one surprises people, and it shouldn't. Different lenders have different risk appetites. They have different internal policies, what lenders call overlays. One bank might be conservative this year, lower DTY limits, stricter income verification, higher reserve requirements. Another might be more flexible. Neither is wrong, exactly. They're just running different calculations about acceptable risk. OCC guidance, that's the Office of the Comptroller of the Currency, explicitly says that lenders with lower risk appetite may require higher down payments and stricter DTI thresholds, while others may accept more risk. Same borrower, different policy box, different outcome. And this shifts over time. The Federal Reserve Senior Loan Officer Survey from early 2026 shows that banks adjust their standards based on the economic environment, what's happening with property values, their internal portfolio quality, what they expect the next 12 months to look like. So sometimes you weren't rejected because you're uncreditworthy. You were rejected because of a lender's current policy box. And a different box, at a different lender, or even at the same lender 6 months later, might open. You weren't necessarily rejected by credit. You may have been rejected by a lender's current rules. Example 1. High score. Rejected. Someone has a 780 credit score. They've never missed a payment in their life. They apply for a mortgage. Rejected. Why? They'd recently moved into commission-based sales from a salaried role. Their income had gone up, potentially, but it was now variable and there was no 2-year history of commission income for the lender to average. At the same time, their DTI was at 48%, and their savings were minimal, enough for the deposit, but nothing left over as a cash buffer. The score was irrelevant, the file was weak on stability, DTI, and reserves. 3 separate flags, none of them connected to their credit history. Example 2. Lower score. Approved. Someone with a 690 score applies for a mortgage. They get approved. They've been in the same NHS role for 6 years. Stable salary, consistent overtime. 2 years of P60s that tell a very clear story. Their car loan is nearly paid off. DTY, 29%. They've been saving consistently and have 4 months of mortgage payments sitting in a savings account. Their deposit is 22%. The score wasn't stellar, but the file was clean, verifiable, and low risk on every axis that actually matters in underwriting. They got approved. Example 3. Approved at one bank, rejected at another. Same person, same week, 2 different applications. Bank A approves them, Bank B declines. Why? Bank B has been tightening its standards. They're running more conservatively this quarter. They've set a 40% hard cap on DTI, and this person is at 42%. Bank A's current appetite is slightly more flexible. Same borrower. Completely different outcome. Example 4. Credit card declined despite good credit. Someone tries to increase their credit card limit. they have a good score declined. Why? Under UK and US regulations, card issuers are required to consider your ability to make minimum payments based on income and current obligations, not just your score. The issuer looked at total existing credit, current balances, and income, and decided the risk of extending more credit outweighed the score signal. The score said reliable. The capacity check said already stretched. Here's something that most people don't realize. If you're rejected for credit in the UK or the US, the lender is legally required to tell you the actual reasons, not just your application was unsuccessful. Specific reasons. The CFPB has made clear that it's not enough to tell someone they failed an internal scoring model. The adverse action notice has to point to specific factors. Things like income insufficient to support the obligation, excessive obligations in relation to income, unable to verify income, temporary or irregular employment, limited credit experience. Read those carefully. How many of them are about the credit score? Almost none. They're about income, about obligations, about verifiability, about stability. So if you've been rejected and you have a reasonable score, go back to that letter. The reason you were rejected is almost certainly in there. It just might not be the reason you expected. The score is rarely the explanation. The explanation is usually one of the 5 factors we walk through today. Okay. So what do you actually do with this? If you're preparing for a mortgage, a loan, or any significant credit decision in the next 12 to 24 months, here's where to focus your energy. First, lower your DTI before you apply. Not your score, your debt load. If you have a car loan with 8 months left, consider whether it's worth clearing it. If you have revolving credit card debt, pay it down. Reducing your monthly obligations directly improves the ratio that underwriters actually look at. Second, stabilize and document your income. If you're freelance or self-employed, this one's harder, but it's worth knowing. 2 consecutive years of tax returns that clearly show stable or growing income will carry more weight than a great year followed by a thin one. If you're salaried, be cautious about changing jobs close to a major application. That history matters. Third, build reserves beyond the deposit. Don't arrive at a mortgage application with exactly the deposit and nothing else. Having 3 to 6 months of projected mortgage payments sitting in a savings account tells the underwriter something important about your financial resilience. It moves you out of the 1 bad month away from crisis category. Fourth, make your income verifiable. If any of your income comes in ways that are hard to document, irregular transfers, cash payments, income that blends with a business account, think about how to make that cleaner before you apply. Not for tax reasons, for underwriting reasons. And fifth, when you're rejected, actually read the denial letter. The reason is in there, and it almost certainly gives you a clearer roadmap to approval than chasing a few extra score points would. Here's what I want you to take away from today. Your credit score is not a verdict. It's a signal, a useful signal. It gets you in the conversation. It tells a lender that you have a track record of handling debt responsibly. That matters. But the conversation doesn't stop there. Once you're in the room, the lender is running a completely different process. They're looking at your income, your obligations, your stability, your assets, your ability to weather a shock. And that process, underwriting, is where approvals and rejections actually happen. Understanding that distinction won't guarantee you'll get approved for everything you apply for, but it changes what you work on. It stops you chasing the wrong number, and it means that when something goes wrong, you'll actually know why and what to do next. That's the model. That's the mechanism. Your score opens a door. Underwriting decides if you walk through. If this helped clarify something you've been confused about, hit subscribe. We do this kind of explainer every week. And if you've been rejected for credit and found something useful in this video, drop it in the comments. I genuinely read them,